Today we're addressing something that could have a massive impact on your financial well-being, whether you're actively trading or just have your savings tucked away in a portfolio. The markets are on the edge, and it's time to pay attention. Bank of America has just issued an urgent warning that affects every investor. It doesn't matter where you bank or how much you invest. What's happening in the market right now could catch you off guard if you're not prepared. So, what's the big deal? Why is this warning from Bank of America so critical? The message is clear. The majority of investors are positioned completely wrong, and if things don't change, they could be in for a rough ride. We'll be breaking down exactly what's happening and why this warning should be on your radar. Let's dive straight into the heart of the issue: market mispositioning. According to Bank of America's latest research, led by top analyst Michael Hartnett, investors are significantly overexposed to stocks while almost ignoring bonds and other safer assets. Here's the data. Roughly 62.6% of assets under management are in equities right now. To put that into perspective, that's near the highest level we've seen in the past 20 years. In contrast, allocations to bonds, one of the most traditional safe havens in uncertain times, are sitting at just 19.8%. And if you think that's low, cash levels are even lower. So why does this matter? Well, we all know the stock market has been doing well over the past few years, but the problem is, when everyone piles into the same trade, in this case, stocks, the risk grows exponentially. It's like being on a boat that's starting to tip because everyone's standing on the same side. When the market turns, and it will eventually, those heavily invested in stocks could be caught completely off guard. One of the reasons this mispositioning is so risky right now is the recent wave of global rate cuts. In September alone, we saw 26 rate cuts worldwide. That's the fourth largest monetary stimulus of this century. Now, you might think rate cuts are a good thing. They usually are. But here's the catch. Despite all this stimulus, the long end of the yield curve hasn't moved in response to inflation the way we'd expect. That tells us that inflation isn't the problem we're facing, yet. But what happens when inflation kicks in and the yield curve unhinges? That's when we could see the cracks in this market. Another factor that most investors might not be fully aware of is the role of machine trading. Now, I know it's not exactly news that machines and algorithms dominate the market these days, but what most people don't realize is just how much influence they really have. Billions of dollars in trades are being handled by algorithms and machines, not human traders, and this creates a very different kind of market. Machines don't have emotions. They aren't looking at the news the way we do. They simply follow their programming, and right now the machines are heavily invested in stocks. They're long the market. In other words, they're betting on stocks continuing to rise. But here's the thing. When these machines hit certain thresholds, they can start selling, and they can do it in a blink. That's when we see those sudden, sharp drops in stock prices, what we often call an air pocket. This is a key reason why Bank of America is sounding the alarm. It's not just that human investors are overexposed to equities, machines are all in as well. When they start selling, the market won't just dip, it could plunge, and fast. Now let's talk about the big players, the institutional investors. This is where it gets really worrying. Institutional cash levels, in other words, the amount of cash that mutual funds and big financial institutions have on hand, are currently at a record low. Right now, mutual fund cash levels as a percentage of total assets are sitting at just 1.5%, the lowest level on record. What does that mean for you? Well, if these institutions don't have much cash on hand, they don't have a lot of flexibility. If the market takes a nosedive, they can't easily buy more stocks or bonds to stabilize their portfolios. And if they're all in on equities, just like many retail investors, they'll be looking to sell, not buy, when the downturn hits. That creates a perfect storm. Nobody has cash, everybody's selling, and the market spirals downward. Finally, let's talk about corporate buybacks. This is another crucial element that's inflating stock prices right now. Companies have been buying back their own shares at record levels over the past few years. This is great for shareholders in the short term because it drives up stock prices, but it's not creating any real value. It's a bit like inflating a balloon without adding any substance. Eventually, the air has to go somewhere, and when it does, the balloon pops. Many companies are over-leveraged because of these buybacks, meaning they've taken on more debt to buy back their own shares, but they haven't necessarily invested in their long-term growth. So, while stock prices might look healthy now, there's a lot of risk hidden beneath the surface. This is yet another reason Bank of America is warning investors. Corporate buybacks are propping up prices, not actual growth. Now that we understand why Bank of America is ringing the alarm, let's take a closer look at the technical indicators that back this up. One of the key tools analysts use to assess market momentum is the Relative Strength Index, RSI, and the Moving Average Convergence Divergence, MACD. These indicators tell us whether the market is overbought, oversold, or somewhere in between. Currently, the S&P 500 is showing conflicting signals. On the one hand, daily momentum is still positive, meaning there's continued buying pressure. However, we're seeing a concerning negative divergence in the weekly RSI, where despite rising prices, momentum has started to weaken. Historically, this kind of negative divergence often precedes short-term corrections. The MACD is also flashing warning signs. The indicator is nearing a sell signal, meaning that momentum could shift downward soon. This doesn't necessarily mean a full-scale crash, but it suggests we're likely to see increased volatility in the coming weeks, especially with the market nearing the end of an extended rally. What makes this situation even riskier is the bearish divergence in volume. This is a classic signal that tells us fewer buyers are pushing the market higher, which suggests the rally could be running out of steam. When we see prices rise but volume fall, it often precedes a reversal. In other words, we might be facing a potential bull trap, where investors think the market is strong only for it to drop suddenly. If we break down the technicals further, we see that the S&P 500 has broken through key resistance levels but with weak momentum. The next support level sits at around 5,500, where the 100-day moving average resides. Should the market correct, this is the first level where we'd expect buyers to step back in. Let's now zoom into individual sectors, starting with technology stocks. Tech has been the leader of this rally, driven by both fundamental and speculative growth. However, recent technical analysis shows that the sector's momentum is starting to slow. The RSI for key tech stocks is hovering around overbought territory, indicating the potential for a pullback. That said, seasonality still supports a short-term rally, especially heading into year-end, but caution is warranted. In contrast, small-cap stocks are struggling to break key resistance levels. These stocks are often more sensitive to economic shifts, and their failure to gain significant momentum is a red flag for broader market health. With machines heavily positioned in small caps, any sudden shift could trigger a cascade of selling. Next, let's talk about real estate and financials. Both sectors are in the spotlight because many investors believe that lower interest rates will naturally boost real estate and bank stocks. However, this assumption overlooks some key factors. Real estate investment trusts, REITs, are seeing momentum slow down, with several technical sell signals flashing. Financial conditions are tightening despite rate cuts, which limits how much borrowing and spending can boost these sectors. Moreover, financials have a unique risk in a lower rate environment. Yes, lower rates can encourage borrowing, but if financial conditions tighten, banks may actually face reduced profit margins. As a result, any rally in financials may be short-lived, especially with recent signs of slowing momentum in bank stocks. Now, let's talk about the pain trade that Bank of America is warning us about. A pain trade occurs when the market moves sharply in the opposite direction of where most investors are positioned. In this case, with so many people piled into stocks, especially tech and financials, the pain trade would involve a rapid sell-off in equities, catching everyone off guard. Historically, the weeks leading into elections are notorious for market volatility. Investors tend to be jittery about policy changes, and we often see an air pocket where stock prices drop suddenly, only to recover post-election. The risk this time around is amplified by machine trading and algorithmic positioning. As machines start selling, the downward pressure could become exaggerated. Bank of America's Michael Hartnett believes this is the setup we're facing, a market overbought, low on liquidity, and highly vulnerable to a sharp correction. The yield curve is still signaling recessionary pressures, and if we see more economic data pointing toward a slowdown, the pain trade could hit hard. We've covered the risks, but now it's time to talk strategy. If you've been following the traditional path of holding a stock-heavy portfolio, you've already seen how dangerous this can be. The good news is that there are opportunities out there, and one of the most overlooked ones is the bond market. Right now, bonds are underowned by both retail and institutional investors. Despite the market turmoil, many people are still hesitant to move into bonds because they associate them with low returns. But this is where the opportunity lies. As rate cuts begin, bonds become a critical asset, especially long-duration treasuries. Bank of America's analysts, including Michael Hartnett, have pointed out that investors should be paying more attention to long-duration bonds, especially with the yield curve signaling a coming recession. When the Fed starts cutting rates, as they're expected to in the coming months, long-term bonds will likely rise in value as yields fall. This isn't just about playing it safe. There's a real opportunity for growth here, as historically, bonds have surged during rate cut cycles. The numbers don't lie. According to the latest data, allocations to bonds remain at historically low levels, sitting at around 19.8%. This is far below the 20-year average, and that means there's room for prices to rise as more investors inevitably turn to bonds as a safe haven. If you're looking to protect your portfolio and capitalize on this opportunity, now is the time to start shifting towards bonds, particularly treasury bonds with longer maturities. In fact, if you look at machine positioning, you'll notice that many algorithmic strategies are also shifting toward bonds. Algorithms are following the same logic we're discussing here. When volatility rises, they move away from equities and into safer assets. This means that if you're ahead of the curve, you can get into bonds before the big money fully flows into the sector. Besides bonds, let's talk about commodities and other safe haven assets. Many of you have asked about gold and whether it's time to increase your exposure there. Gold has been on a strong run lately, with 41 consecutive daily buy signals, which suggests that momentum is still in favor of the precious metal. But here's the catch. Gold is now overbought, and that typically means we're due for a pullback. I'm not saying gold won't continue to rise in the long term, but if you're thinking about entering the market right now, it might be better to wait for a pullback. Historically, whenever momentum in gold reaches these levels, we see a period of consolidation or even a short-term dip before it resumes its upward trajectory. So, if you're patient, you'll likely get a better buying opportunity soon. Another commodity that's worth keeping an eye on is oil. Bank of America has been recommending a long energy short utilities strategy for Q4. This is because oil has been in a tight supply environment, and geopolitical risks are keeping prices elevated. However, while oil prices could stay high in the short term, remember that they're vulnerable to sudden declines, especially if global geopolitical tensions ease. If you're looking for something less volatile, agricultural commodities like soybeans are also presenting strong technical signals. As we've discussed previously, soybean prices have been rising steadily, driven by a combination of supply shortages and strong demand. This makes them a good hedge against inflation, especially as food prices continue to rise globally. So, how do you put all this into action? If you've been watching the markets closely, you already know that staying fully invested in stocks, especially tech stocks, is a risky move. The pain trade is real, and as we've seen from Bank of America's warning, most investors are simply not prepared for what's coming. The key here is diversification. First, start by reducing your equity exposure, particularly in sectors like tech and financials, where valuations are stretched and the risks of a pullback are high. Instead, Look at increasing your exposure to bonds, specifically long-duration treasuries. This will not only provide you with a hedge against a market correction, but it will also position you for gains as rates begin to fall. Next, consider allocating a portion of your portfolio to commodities with a focus on safe haven assets like gold and potentially agricultural commodities like soybeans. These assets provide protection against inflation and can perform well during periods of economic uncertainty. Finally, keep an eye on the technical indicators we discussed earlier, RSI, MACD, and momentum. If you're tracking these closely, they will give you clear signals of when it's time to move back into the market or make further adjustments. And don't forget to stay informed. The markets are moving fast, and being ahead of the curve is crucial. If you're not already subscribed to our alerts, now is the time to join. We track machine positioning, technical indicators, and sector movements in real time, giving you the edge you need to make informed decisions. Thanks for tuning in. I'm Watchdog, and as always, we'll continue watching the market so you can stay one step ahead. Take action now and make sure you're on the right side of the trade. If you liked this video, please give it a thumbs up and subscribe to the channel. See you next time.